going on, man?
I'm well, buddy. How are you?
Good seeing you.
Always good to see
I
you.
haven't seen you since what was it, State of the Market last year with
Been that long?
John Miller and Cale Goodman.
Oh, yeah,
Yeah,
that's right.
I went to Africa after that.
You hiked Kilimanjaro, didn't
I
you?
did.
You make it?
I did. I made it in one piece. How about you? What's going on?
Everything is good, Thank God we're just spent a week in Arizona for our sales conference, which was great. Got to spend some time with our leadership team and talk about the year ahead and some of the stuff that we're working on, which is exciting. Spent the weekend before that in Dominican Republic, relaxing a little.
Bad, you got a nice tan.
So I'll take that. I don't know if it's tan or stress, but I'll take it either way. And thankfully, market's been busy. We're busy.
Is it?
Yes.
Well, I guess we'll get into it in
The
a
weather,
second.
ever since the weather warmed up.
There's always a direct correlation, but also you've been with the bank for a while. 2003.
2003, you did your research.
Well, if I remember correctly, from my perspective, in 2007, 8, after the Great Recession, Wells became really bullish while other banks pulled out. Am I remember correctly?
I always say the best thing I ever did was never leave.
Wow,
22 and a half years later.
amen to that.
No, and that was actually a moment where really, thankfully, we had the balance sheet and the dedication to the business, and we were able to ride through a difficult time and be very successful.
I remember they were underwriting projects that other banks didn't even want to touch. They had all kind of requirements, and Wells was making a big step on my stage at least. I'm sure in New York as well. Um, it was a different landscape, though, right?
Yes, I mean, but I also think it's just a constantly changing landscape, both lending and some of the regulatory requirements,
right.
but then also just the market itself. So it's kind of like an ever evolving
So
puzzle.
I think dollar volume is different. Regulations are different a little bit. The mechanics of the deals, are they still the same, or you feel like there was something significant to change on that front?
I mean, the volume of transactions has definitely diminished substantially, at least on our end for the financing, because not only have transactions in totality dropped over the last few years, but then when you start looking at the percentage of cash transactions north of 3 or even 4 million in the market, I think last year ended the market was at 67% of the market over 4
That's
million.
incredible. That's just
Amazing. But what we do see different is I'm not sure. In fact, I'm positive, I'm confident that a good percentage of those transactions were not really technically all cash. So they may have acquired the real estate in cash, but we see a lot of customers different today taking alternative forms of financing. And so whether that's that they're borrowing against their marketable securities to close in cash, or even borrowing against less liquid assets like their limited partnership interest in, private equity businesses that historically weren't as liquid in that way, but Wells has stepped in and some of the other large financial institutions are now willing to lend against less liquid securities.
and well, also a different environment. In 5 years ago, the rates were a certain level. I remember you did my deal. It's well below 3%, and so after the rapid increase in rates, did the business fall off a cliff? Like, what happened? 22, 23? How did that?
Yeah, well, it just no. I mean, our my volume fell off from 22 to 23 by north of 50%. I mean, just fact based, about half of our volume was refinance volume, and it fizzled away immediately once rates, climbed up into the kind of 5% range. Um, and everyone had refinanced multiple times at that point. So listen,
Right. And purchased. I mean,
it was a
purchased that
gift for
whole
a long
while.
time. We appreciated it, while it
It was good that
lasted.
it lasted.
And then all through COVID, we had, tons of activity outside of the city. But no, you're right. So not only did refinance volume fall off, but purchase volume dissipated because, affordability became somewhat of an issue, right? And so you had buyers who were looking to purchase, but there wasn't necessarily inventory for them to acquire. Or once they started running the math on, how does this pencil out at a 5.5, 6.5% interest rate? The monthly payments just seemed unobtainable. And then the fact is, as
I
you
mean,
know,
double, more than double, which is insane. It's used to a reality, a certain reality for a very long time, by the way. We're like in that. I think we both knew it at the time that it's such cheap money that you kind of, whoever could, should have. I mean, at the time it looked normal, but I knew it's going to end at some point. And then be back to that kind of now a reality in which I think we were hoping for a long time that the rates will drop and we're back to business. It never happened. But if I may make a few assumptions, assume that many of the borrowers in that, like say 2020, 21, used an ARM loan.
mhm.
So it's between 5 to 7 and 10, let's say average is 7. Are we going to see a wave of people coming now to market in 2027 just because they're sitting on their low rate? But if they have to refinance now, it doesn't matter. They just sell or move on.
I do think that. I think there are a very large percentage of our buyers, our affluent client base in kind of the New York metropolitan and even the tri-state area, are very comfortable. They're sophisticated financially, and so they're comfortable with adjustable rate mortgage products. And so I don't know what that exact percentage is, but a large percentage definitely took those arms. And if they were taking them at some point in 2020, 21, we should start to see resets coming over the course of the next year. So we're already starting to see that inquiry from those customers saying, I'm about a year out. What do things look like? And candidly, if someone were locked in somewhere in the mid to high twos, their first adjustment cap is typically 2%, or at least with our ARM products, you cannot increase more than
Right.
2% in your first adjustment year. And so that rate of, let's say, 2.75 would adjust to 4.75. For some of those clients today, we could deliver 4.75 on a new 7 year arm, and cap that rate where they'll adjust. But because they're still a year away and there's so much uncertainty in the market, we don't really see any of those, very few of those customers actually pulling the trigger to pay a higher rate today to ensure that they're capped at that 4.75. But
So
I anticipate a surge in volume over
So
the next year.
they're sitting on real estate that they're not selling and they're not buying. So kind of twofold. If they decide to start moving, we may see a little movement in the market. Although we are seeing still probably going to see a high rate of cash buyers, but I think it's a great incentive for people to move away, especially when the rents are so crazy. How else can I say it? In the city, they're very, very aggressive.
Well, I think you make a great point that I think hopefully what will happen also is that you'll see, the empty nester or the person looking to buy up be willing to give up that 2 and 3/4 interest rate to buy in the fours, right? Or to exit the property they're in. So you have a son of empty nesters that are just holding on to, let's say, large properties. They may live in a 3,500 square foot co-op on Park Avenue, and it just doesn't make sense to sell it today based on the cost to buy something new, right? Where if and when rates drop and they can, should create more demand for their property, hopefully give them a better price premium and also make it more affordable to move. Hopefully, we'll see some increased transaction volume.
Well, I don't want to dwell too much on that. It's very technical, but do you think the war will have what kind of impact? I mean, on one hand, it's an inflationary environment because of price of the oil. But do you think after the fact, let's say it ends in a matter of a couple of weeks or maybe a month or so, what do we look like after? Do we see heightened inflation? Do we see rates going back up? Maybe.
I mean, you're asking a really, difficult question in
I
that
know,
moment.
I
I mean,
know.
I think we're one tweet away from anything these days,
I like that. One tweet away.
regardless of your political views. It's our reality today, right? And
Right.
so
Unstable.
we're in a very unstable global socioeconomic climate, and so who knows. I think if the war ends quickly, then yes, the price of oil should settle, inflationary concerns should fizzle a little bit, and hopefully the 10 year will settle back down and mortgage rates correlate very closely with 10-year treasury.
Right.
On the other side of it, there's like the AI effect, and really what is the impact on employment? We're already starting to see it, right? Where jobs are being created, but you have a lot of jobs that seem to be being eliminated with AI, and and,
I,
and
I'm
what's
I'm
the
yet to
impact?
see that. I know that people talk about it a lot. I think we are going to try and see that how this plays out. Um, but as of today, the jobs that are mostly seems to be going away are mostly the white collar, not the blue collar jobs. The blue collar job, especially mechanics, plumbers. I heard, what was that, in North Korea, in South Korea? I think it's in Singapore, South Korea. They're training people in those professions moving forward: engineers,
Hmm.
mechanics, plumbers. It's something that I don't think any robot will take over soon, although you never know with this reality. Um, but going back to where we're at right now, it seems like in spite of all the craziness around us in the world, it seems like the U.S., New York, still a very good place to buy property in spite of all everything is going on. If you look around the world, especially in Dubai, I don't think anybody's buying a vacation on Dubai right now, but Europe, Asia, Middle East, even London. It seems like the confidence is still here, and I love that about the city. And you've been dealing with a lot of high net worth individuals and people. I mean, they're mortal human beings just with money. Um, what's a common trait for these people? If you learned anything about that, type, about something common to people like that.
Time is most people, or at least affluent New Yorkers, is their most valuable commodity. Don't waste people's time, right? So I think that, the ability to, quickly and thoughtfully evaluate someone's scenario and to be able to convey to them your ability to execute or not. And so I have calls every day. And I think one of the things that have helped me build my business over the years has been that people know that I'll be very direct about something that I think we can't do, just as much as I'll be clear about what I think we're very capable of. And so I think being able to evaluate a scenario and set that expectation quickly is a very important quality to have when you're working with an affluent client, because their time is valuable and execution is the most important thing. So I have also found that you can have a client that loves you, invites you over for Passover dinner, has you to their beach house in the Hamptons and is happy to spend time with you. But if you can't execute for them, there's nothing to really talk about otherwise. And so if you make a commitment to deliver, you need to deliver and you need to do it timely.
Time is money.
That is very true.
Are you able to, I mean, do you do it on a call, or you do it back and forth, or you try to cut, I guess, all the back and forth, sending the document, let me see where you are. You try to get a feel from them saying, if you were like that, I can help you, assuming what you're telling me is, about right.
So most successful people, I think, are intelligent and tough, right? And I'll take smart and tough any day, because I think that they under most of those clients, as long as you're clear about what it is you will need and the time frame that you're outlining, understand it. They'll push you because they want it done yesterday, because we're New Yorkers and we have an insatiable
Right. Sounds
appetite.
like a very New York thing.
Right.
Tough, short on time.
Right. Um, but it's also something they want. And so when you're delivering, an interest rate in the mid fours, and they're excited about buying a product that you understand, and hopefully we can provide, thoughtful insight on. While I'm not a CPA, a lot of those cash transactions we see that we're providing, alternative forms of credit to close in cash, there's really tax strategies behind them. So whether it's that you're not selling your securities and incurring cap gains, and so you borrow against them, right? So you eliminate a tax liability there, or by extracting the equity and placing a mortgage after they've closed in cash, there's some tax advantages
Right.
to deductibility. And so um, I think people are happy to spend time with you if you're bringing value, right?
That's a good one. Absolutely for that. I think also those people that are successful, high net worth individual. I read somewhere that the wealth gap, but it still exists big time in the world, it's not generational any longer. So it means that the wealth is being created almost at every generation. And I noticed that a lot of the successful people that I work with, that I know, are incredibly hard workers.
Hmm.
That's something that, forget the movies, forget about you hear about. I notice these people work and work hard. And I learned that about anybody, even I tell my kids, talent is like few percent of the whole equation. Even the athletes you see in the Olympics, they had talents, but at the end of the day, they need to work their butts off and ongoing. And I see that also in our industry, in your industry, in my industry, all the best players I know and work with, working very hard. And I think it comes with the feel of New York. I know the TV shows show something different, but that's, we're not going to go there today.
Right, that's true. I mean, listen, my mother's favorite quote is "Hard work makes you lucky." We bought my mother a sweater that said "Hard work makes you lucky" because she constantly quotes it to us, since we were little boys. And so I agree. I think it's a common theme amongst pretty much every successful person, people that are very resilient, willing to work hard, willing to fail. I think my kids get very annoyed because I constantly quote Rocky that it's not how hard you can hit, it's how hard you can get hit and get
Okay.
back up and keep going, right? And that's how winning is done. And so most successful people, I think, are resilient people who work hard and pick themselves back up and dust themselves off and go at it again.
I guess we all need some of that.
Get Harry Macklow.
Is he up? I didn't check his thing yet.
But I mean, you just,
Yes, yes,
you,
incredible
you,
business person, and that's what they do,
you
and
know,
they're married to it, and I appreciate it in our city. So if you had to choose, I mean, you need you need expertise and you need emotional IQ. So technical expertise or emotional IQ?
mm. Listen, I've survived the last 49 years on emotional IQ.
I appreciate the
um,
sincerity. So what do you say? You don't know anything
or
about
emotional
mortgages?
EQ. Sorry. But no, listen, I think you have to be technical, or you need to surround yourself with people who are technical and recognize where, I mean, I'm very detail oriented, but I'm not necessarily the most technical. But Josh on my team, Sean on my team, like they're laser focused, super
So you have the
technical.
people that complement some of that, and you're like a little more about the people.
Definitely.
If you had to, I love that. That's like it's a glimpse into, and different people are different. Like I'm a Capricorn. I need everything organized. I need to know that you're all like buttoned up. And they say in general, I think what's his name, Jordan Peterson. He says that women are interested in people and men are interested in things. And sometimes we fall into that, but it's definitely your business, my business about people and the
For
line of
sure.
work with people. And it's a um I think it's a very important part of our work that sometimes I try to detach from the technical aspect of things and try to see the person and how we can engage in a more meaningful, and a lot of my clients, the developers I work with, like 10-20 years of relationship, that's like
Yeah.
very very deep.
So really quick, I would say like it also depends on what you define as technical. So like, am I super technical in terms of like the systems that we're using internally? No. But my knowledge of kind of the New York real estate market, new development buildings is pretty encyclopedic over this last 25 years without patting myself on the back. Like, so I think when you speak to one of your developers or a client, the 20 plus years of experience that you have or that I have in the market, the little details that you see when you walk a site, right? Whether it's financial and how, the debt stack is put together, or whether it's, the FAR or how you're laying out homes, like, or to how a baseboard lines up, with a doorway, right? Like these are things that you and I have developed, you know, very technical skill set in.
Kind of bothers you in the eye if it's not all right. You don't even, you say, you walk in and see a space, and you have tremendous business, and you do new development, you do resale, but let's talk about development. What is your perfect project if you had to pick? Like for me, I can go all day long. It's a very long list, but for you, the perfect project to work on. I know you worked with the best of them. You worked with Related, Taconic. We've done together
Yeah.
some work. What does a perfect project look like from your standpoint?
Perfect project, regardless of size, is when you really have the right team collaborating together. So when you have a great agent marketing the product, you have someone on the financing side, great legal, and an operating partner and equity partners that are really aligned in their vision, trust each other, and really work in a collaborative, proactive way. And they kind of like remove ego from it. And clearly, money matters, right? Because we're all there to make money, but there's also like a vision for the project. And so I would say it's really about the team working together more than it is the excitement of like a Hudson Yards, which is clearly like a spectacular project that like reshaped the skyline of New York, or Essex Crossing where we worked, and it's just amazing to see what's evolved down there. But funny enough, I almost prefer a project like a mid-block 10-unit, conversion where the developer's very involved because every dollar counts, and they really respect and appreciate our involvement to help not only finance the end loans, but actually convert sales and be really a good partner. We end up capturing on a 10-unit project, I'll probably capture 6 units, where I may only capture 6 units on a 100-unit project, because that 10-unit project, we're working as a more cohesive strategic team.
It's incredible.
It's a long-winded answer,
Yeah,
right?
it's and some of the 10 well, when we talk about 10 units, we're actually, yeah, 10 units happened to be the project you introduced to us in the Lower East Side like 4 years ago, 3 years ago. That was an incredible run. That was just like out of the blue. I love that.
And what's funny is that same developer, sorry to cut off, was the project I was thinking about, was a project on 17th Street between 5th and 6th that he did before that, was the project I was actually thinking about, of like an ideal project where we end up capturing like 6 or 7 out of 10 units, because everyone's working as a team.
Let's see what happens with the next one. I hope he can do that too. And so moving to that project scenario where we're looking into, you see how the city is moving forward, especially with new developments. Less development, a lot of big pieces that are happening, especially with Excel, with specific developers that are doing big stuff. And Zeckendorf, so everything they do is large scale. So the 200, 300 million became half a billion. The half a billion became $1 billion project, which is incredible. The volume is growing, and we are looking at what does it look like moving forward. What does the future look like? What do you see when you look at the city? Because you've been here forever, and now you're looking forward into the future, seeing what's on the drawing board. What does the future of the city looks like in moving into that, feeding off that ultra luxury buyers you see whenever a very high project comes to market? Actually, there's no lack of buyers in almost every price category. Look at 80 Clarkson.
Right.
It's like, look at it. Even Burnett at Central Park Towers. There's so many units over $20 million. It's mostly sold. Naftali's coming out at 800 Fifth Avenue.
Right.
And it said that, half the units or more are spoken for. It looks rich, the
Sounds like we
future.
should all be doing whatever Mickey Naftali's doing.
Ah, well,
'Cause
he's got a good formula.
he's figured out the model. It's interesting. Like, I don't have as much insight on, what are the new variances to code, or what are the, sub markets within the market where there might be some sort of change that might lend to a developer wanting to target a certain area. But I think the political landscape is a huge component of what we will see, right? And what will developers be allowed to do? What incentives will be provided? I mean, there's clearly a housing shortage, right? And so the question is do developers start building affordable, because that's what they're incentivized to do over, high end condo, right?
Or not incentivized, which is why we're in this environment.
Correct. But I think it's really going to depend on who the new mayor, appoints in certain positions, and what that landscape ultimately looks like, to really know what that next, surge is. I do think something I think about a lot, and I'm not really sure where I am with it, is this massive amount of co-op inventory that exists on the Upper East Side, on Park Avenue and otherwise, where you have a generational shift today. Most of those tenants are, are are at the end of their life. And so what will happen with those properties? Who will take them on? Who will renovate them? And what does that look like from a price perspective? right? Because Mickey Naftali seems to be able to sell a product for 3,000 a foot on 86 and Madison, on 82nd and Madison, on Second Avenue, on Third Avenue, right? Um, which is all pretty much, I think, Robert A.M. Stern architecture. It's all kind of branded out of like reimagining a Park Avenue co-op
Yeah.
with, some sort of contemporized feel and highly amenitized, package. The question is like, I don't know. For me, it just seems interesting. What is the opportunity in that co-op space? Will the boards evolve?
Right. When those co-ops are selling for, I don't know, $1,400 a foot,
Or 1,000,
right?
right?
Right. The price disparity is huge.
Right. The problem is to take that 1,200 a foot, let's say co-op, and bring it up to par with a new dev is probably another 1,200 a foot.
Right.
It's not 650, 700, right? So you end up at 24, 2,500 a foot anyway, and you had to deal with a lot of headaches. So the question is how does that evolve, right? I don't know. It's just something I think about. I don't have any real
It's a
thoughtful
fantastic
strategy
point.
on it, but
It's a great point. The co-ops are very archaic. Their structure is very old. The mechanism is just, holding back a lot of these values that are locked in prime locations. Some of these co-ops are in the best location. I live in a co-op in an amazing location. And sometimes these boards are holding back. Some of them couldn't even get accepted to the one they live in. And it's a very old structure, and it's kind of slowly losing its. Remember the heydays? It's like Park Avenue is the thing to be, the place to be, which it still is to a degree, but it's definitely older.
But that buyer that would never have lived east of Park Avenue is buying in all of these new developments east of Park Avenue because they don't really want to deal with the nuance and the logistics of a co-op board and then the renovation. And I can tell you, I sat on my co-op board downtown when I lived on 15th Street and Fifth Avenue for many years, a white brick, fairly liberal co-op. And in those scenarios, there's malleability. But then I lived, on 89th Street between Fifth and Madison for many years, and I sat on that co-op board, and I can tell you that I was definitely not popular amongst my other board colleagues because I pushed hard to renovate the gym, to enhance the roof deck, to redo the lobby, and keep it within its historical tradition, but to contemporize it in some way. And it took a lot of fight for me to allow for additional financing and things like that.
I think I think that's one part of the market that is going to suffer to a degree. And if I don't know if they can change the legal structure, I don't know if anybody's pushing toward or interested in doing it. But we also have the same time an affordability issue. Right, there's no like new, not a lot of product being built at the moment for rentals. I don't know that a city like New York could ever be really affordable. Is it really? But if we can do it in a suburbs, I'm sorry, not the suburbs, the boroughs, um, and I like the way you look at it. The pockets of the market that can be improved because land scarcity is there, but we're going to continue to probably buy building, vacate them, knock them down, build new wherever we can. It's still happening to a degree, but it's because of the condo. Condo went through a couple of crazy cycles recently. Not everybody is successful. Naftali actually is the outlier. A lot of them in the last few years did make a lot of money. And so that will need to make financial sense moving forward. And I think the next big pocket is still in Midtown. Whatever conversions that we're able to get off the ground already did, in my opinion. I know there's a lot of buildings to be converted, but it's very difficult to convert. I've seen a lot of deals that just physically you cannot turn them into residential building successfully. The good ones were snatched pretty fast. So I think we're looking at the end of it because the office market is definitely coming back. Yeah, the A plus luxury market is pulling that forward to a new kind of rejuvenation. People came back to the office. They need to be, I think, working from home. I think we all know is not really the thing.
Yep.
It's not the most productive thing. Um, I wanted to kind of close it up with an interesting question to you. Historically, the United States have this cycles of the ebb and flow of money gets like to a super exuberant period where things are so crazy and great, and then we find ourselves at the bottom of that cycle, and we've seen it. You remember the heydays of 2005, 6, 7 before the Great Recession?
Hmm.
It's insane. It's just like everybody's buying homes and boats and the bottle service and clubs. Remember, money was so out of control. And then we saw the other side of it. And I happened to read this beautiful book, the Financial History of the U.S. Goes from before the Gilded Age, like, and we always had these cycles, always. And so, where you at right now, would you experience any knowledge if you had to advise your young self when you know the cyclical nature of things exist and the ebb and flow of money, the money supply will always be there? It's kind of try to time it, maybe not the right kind of way to put it, but what would you advice to your young self or to anybody younger that is sitting there and looking at what's happening right now in the markets?
I think it's broad. It's a broad statement, but I think when you're young and you really have nothing to lose, you should take more risks. And I think that taking those risks can result in in great reward. And so I think looking back, my conservative kind of temperament in certain ways has helped me. Right. I've been at Wells Fargo almost 23 years. And like I said before, the best thing I ever did was never leave. And I like the stability of that. But I think that taking risk yields great reward. And so I see it in my 17-year-old son, who's just Max, who's super entrepreneurial and is constantly coming to me and pushing, you know, Dad, what about this? I mean, he sent me this, article immediately when the new mayor came in, and he's like, how do we capitalize on affordable housing? There's all these tax, I mean, he's 17, right? Like, how do we use some of these tax credits to like build something and then, later we can recapitalize it? And he's 17, right? Last night he brought me in. He's like, Dad, stop. ChatGPT is great, but he gave me another version, another variant, a new brand. He's like, watch this. He's like, give me a building you've worked on. And so I randomly said the Belnord, right? And within 6 to 8 minutes, built a full blown investment deck, right? About the Belnord. It had all kinds of analysis, like comparable analysis. It was so professionally done. And because he hosts events, so like one of the businesses that he's in is that he like curates hospitality events. So he'll throw sweet 16 parties or things like that for his age group. And so I didn't even think, and sorry the story's getting long, but I didn't even think about the Belnord and the fact that it has the beautiful courtyard there when I mentioned it to him. But so because it knows him and his previous inputs and that's what he did, it set up the deck to talk about how he could utilize the space to host events, how much revenue he could generate. So anyway, I sidetracked to brag about my son, but I think that like he's always pushing the envelope. He's always taking risks. And it's like I said to my mom last night, I'm like, he's gonna be a billionaire. Like like he's just, and I think
Apple didn't
it's
fall far from the tree.
well, you
We'll
know,
see.
I'm not there, but I love watching him do it. So
Well, listen, man, thanks for coming here today. Great seeing you.
thanks for inviting me.
And
Great to be with you.
we'll see you in the next deal.